Yesterday I talked about what the attacks on Israel could do to oil prices. What about the rest of America's economy? So markets are still digesting the wider implications of the attacks, but we have a couple data points to help estimate what could happen to stocks, bonds, hard assets like gold and Bitcoin, and the US dollar, which has already had a very eventful year. The first data point is Russia's invasion of Ukraine 18 months ago. The second, the worst case, is the Yom Kippur War in 1973. That was the last time that Israel was at war. So first, Ukraine. In the wake of Russia's invasion last year, worldwide, stocks fell, gold and Bitcoin jumped, the dollar got stronger, and bond rates soared. To break those down, stocks always fall, and the dollar always gets stronger when there's global crisis. So people get nervous and they park their money in dollars. For example, even the 2008 crisis, the dollar got much stronger, even though the crisis was, by all accounts, coming from the US. Plus, crises can hit profits, which is fundamentally why stocks are supposed to have value. Also in a crisis, hard assets like gold or now Bitcoin typically also go up. People are nervous and they want to park their money. Plus, crises can raise government spending, which tends to lead to inflation. Bonds, on the other hand, typically fall. In other words, their yield goes up. That's because while investors are nervous, cash is even safer than bonds, plus the expected inflation. So all of those happened in Ukraine, but it turned out the moves were very short-lived. Essentially, markets priced in the worst case, which might have been an escalation beyond Ukraine's borders or something involving unconventional weapons. When that did not happen, they calmed down. So in raw numbers, immediately after the invasion, US stocks fell 20%, gold jumped 12%, Bitcoin leapt 30%, the dollar gained almost 5%, and the 10-year bond nearly doubled in yield. But by October, stocks had already recovered half what they lost, gold and Bitcoin were actually lower than pre-invasion, and the dollar had lost almost all of its gains. The only number that stayed high was the 10-year bond, but that's driven more by Fed rates and the question whether Uncle Sam intends to repay its debts. So back to Israel, yesterday I mentioned the key question is how far the conflict spreads. If it is as contained as Ukraine, then I think long-term impact on markets will be muted, therefore long-term impact on the economy. If, on the other hand, the conflict spreads to Iran or if it ropes in Saudi Arabia and the Gulf, they would be looking at something much more serious. For that, our last data point is the 1973 Yom Kippur War, which featured a full oil embargo of the West and sent oil prices from $3 to $13. In fact, ultimately on their way to $37. That, of course, launched the worst economic crisis in 50 years for Americans. So what's next? Brought to you by Unchained. For the real economy, everything depends how far the conflict spreads. If it is contained, we will get drama in markets, but little on the real economy. If, on the other hand, regional powers in the US are drawn into a deeper war, we could be looking at oil dealing a catastrophic hit to inflation, which would drive the Fed to pull out all the stops and hike interest rates to economy-crushing levels we haven't seen since Paul Volcker. We'll get a lot more information in the coming days, but it's probably not a bad idea to dial down risk, put on the storm shutters, and keep a close eye on events. Okay, we'll be watching. See you next time.